Hey everyone, hopefully you're having a good day. My name's Andy. Channel's Finding Value. We're going to go through Twitter like we normally do, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there. Let's take a look and see what people are sharing. You can follow me at finding_finance, and or you can join our community at finding-value.com. Where I dive deeper into these topics, share my opinions on individual companies a lot more freely, explain my strategies, kind of train on how my approaches are in the sectors that I'm interested in, which is mainly commodity driven at this time, because that's where the value is in the markets. So coming on down, we've got SILJ, back test of the broadenings breakout band. Note that the sideways range has a bullish setup within the plot too. You can see this broadening range here. The Adam and Eve bottom is what he calls it, and the break of the upper broadening range in the backtest. So that very well could be a good setup here for SILJ, the silver junior miners. That could very well go higher. So it looks pretty good in his opinion. My opinion is I think it looks good too. So we've got, so this is this guy's opinion. I'm out of offshore. He rode Tidewater from 30 to 100, 105 and started exiting on Roboti's heavy sells. Don't listen to that person and Cuppy. They mercilessly pump and dump on their followers. If you see that bald, slime ball Judd tell you this thing still has legs to go, get the heck out. Does the offshore oil crew on here worry at all that there is simply too much oil? Well, the thing that I don't like about this, why did he sell based off of someone else selling? This guy could have sold for a variety of reasons. Some of these guys have limit, like they are position limited, and they can't go over a certain percentage uh, based off of limits that they have in their funds. And I think that's what happened in this case. I'm not exactly sure, but I think he sold and had to sell pretty heavily to stay within the limits of his portfolio percentage allocation. So what I would be doing myself is if I'm going to sell a position, I would not sell it because someone else sold it. That's kind of what rookie investors, in my opinion, do. You should be able to hold your own opinions. You should be able to figure out and have a solid reason why you're exiting the position. In my opinion of offshore oil, I think there's more to go. I think there's a lot more to go. Now, that is for the entire bull market. And I've gotten a lot of slack on YouTube and some of these people in the comment section where I called the bull market, the oil bull market, by the end of the bull market in the late 2020s, in my opinion, oil is going to be multi-hundred dollars for a variety of reasons. It's not going to be all based off of supply and demand. There's going to be a lot of devaluation of the dollar in that. And when we have that devaluation of the dollar, money rotates differently in the system. It's going to rotate away from technology stocks and maybe even the S&P 500 and more so towards commodities and precious metals. So when I talk about a long-term price projection, if the price doesn't go straight there, which in my opinion it will not, we're going to get it's going to move up in three big waves like it did last bull market. People are they're going to use the short-term price weakness in wave two, which we're in, to say that I am wrong about that call. Now, I'm not predicting that we're going to get some sort of exact price at an exact time. I am saying that the bull market over the 2020s is going to go into multi-hundred dollars and we're going to get pullbacks. So I'm not, even though the price went down during wave two, I wouldn't say that I am wrong. The same thing is going to apply for these offshore oil companies. They are going to get pullbacks along the way. And what people are going to do is they're going to use those pullbacks as a justification of why this stock or sector isn't going to go up during the entire bull market. But they are wrong, in my opinion. They're going to be very wrong. I think there is a lot of legs left in this bull market for oil. I think we are going multi-$100 oil, between $200 and $500 a barrel. And a lot of it's going to depend on the value of the dollar. Most regular thinking people are going to say that that is impossible. And how are people going to afford that? What I'm going to say is they will not afford it, and they must be priced out of it because the dollar is going to get hit. And there's going to be some demand destruction, put it that way. And that very well could spark a very big recession, is what I think will happen at the end of all this. The wealth coach says you're stupid if you buy a house now at the top of the market. The problem is regular people have been saying that in 2015, 2016, 2017, 2018, 2019, 2020, 21, 22, 23, 24, and all of the people, a lot of these people who are very bearish on housing on YouTube, they've been saying it the entire time. And what he says is, glad I didn't listen to them. That's one of the reasons I started my YouTube channels, because so many people were bearish the housing market in 2020. And I was like, guys, you must not look at any data outside of the little data that people look at. And when the housing market moves up and down, the data that I'm talking about, they get bullish when the data goes up and they get bearish when the data goes down. And now a lot of people are just bearish no matter what the data says. And they'll use any piece of data to try to be bearish on something because it gets more views. So what do I think? What's my opinion on it? I think we're going to go up. And the reason I think we're going to go up is because I think there's a strong volume of buyers that have been priced out of the market due to affordability. And if we do lower rates, that's a big if. I don't know if they are, but if they do, they're going to lower rates right into the affordability of that volume of buyers. So that is my take on it. And I do think that we are underbuilt still in single family homes for residential. And that's where the majority of loans in the system comes from. And that is what drives the cycle. It is the leading indicator and the root cause of the cycle. It is the demographic is the ultimate root cause interacting with the housing market, and the loans and the expansion of those loans and credit into the system against new homes, which is very inflationary. It's money actually getting into the system and circulating within the system. If you do not have that demographic, what you will see is you'll see a declining home price, which is declining credit, and you struggle, the economy will struggle to get credit into the system. And you get disinflation or deflation like Japan is experiencing. And China is going through it right now too. They have a bubble on their hands because there's no demographic coming up behind it to soak up any homes and to increase the demand for those homes. Peter St. Ange, or whatever, how do you ever say it? Now, I just want to address this. These are the Bitcoin people. And all the Bitcoin people say this same crap. And I just want to tell you their thinking, their thought process. I am very much different, but we'll go through it here. He says, how is Bitcoin valued? Simple. There's 100 trillion or 120 trillion of money in the world. If Bitcoin stands at 1% chance of replacing fiat, it's worth 1.2 trillion or $60,000 per Bitcoin. If it's a 2% chance, 120,000 per Bitcoin. If it's 99% chance, it's 5.9 million per coin. How to calculate those percents? Ask the odds of fiat collapsing, then the odds of gold or Bitcoin replacing it. Personally, on a long enough timeline, I put those odds near 100% for Bitcoin. There's a lot of assumptions here for this guy to make some of these claims. Why do people need Bitcoin? And he is saying that if fiat collapses, that people are just going to naturally go to Bitcoin. I could probably tell you a large percentage of people who are incredibly wealthy probably have no idea even how to buy Bitcoin and will probably never figure out how to actually buy Bitcoin. So the baby boomers who control a lot of that wealth, I'm willing to bet that a lot of baby boomers have no idea how to purchase Bitcoin at all. So a lot of the wealth is probably not going to go into Bitcoin, is my guess. I think Bitcoin, if I can remember the data here I saw a little while ago, it's actually declining for payments. It is going down, and that is not good. So I don't know what Bitcoin necessarily is. If it's not used for payments, do we just hold it because we artificially give it value? And if Bitcoin starts going down, how is that going? How's that all going to work? Is the money actually ever going to come back into it? Because what's the utility case of it? And that is where my doubts lie, is the utility of Bitcoin. I can make tons of cases for the utility of platinum and silver and a lot of these other ones. I just don't know what it is for Bitcoin at this time. And some people will say, oh, it's for, protecting your wealth. It's like you just artificially assign this zero and ones in a digital system and just give it wealth. I mean, give it some sort of value. I don't know. That seems like a far stretched thing. So Patrick Karam says, was silver up over 4.5% today? So it has the ratio versus the SPX. Are you ready? So silver versus SPX weekly log, we're a little bit below, a little bit of resistance here. But we're working our way up, and we are above the massive volume node here. We do have one above us, just above us though. Coming down to Chaz, he says, one of the biggest lies I believed growing up was that investing is gambling. The real gamble is not investing and trying to save your way to wealth. In the past 30 years alone, the purchasing power of $1 has been cut in half. Meanwhile, $1 invested in the S&P 500 has grown to $20, $9 adjusted for inflation. If you want to protect your purchasing power, you need to invest. That is true, but I would say that the S&P 500 is not a great way to really make that much money either, because as inflation has gone up, it hasn't really beaten after-tax purchasing power. So you still lose even though you're buying this. So I actually think that gold and potentially silver here and platinum are less risk and more potential upside than the S&P 500. And I know people use the S&P 500 as kind of the measuring stick, but we've been in a declining interest rate environment for 40 years. Now with the increasing interest rate environment, my opinion has shifted and has favored precious metals for protecting one's purchasing power. So Pomp says Goldman Sachs is predicting big trouble ahead in the U.S. housing market. This would put existing home sales back to levels not seen since 1970s. So News Lambert breaks it down for the Resi Club readers. I don't think that's predicting big trouble ahead. What they're predicting is lower home sales. What you need to do is, this is data. And what occurs is a lot of these guys, they look at the data and then they come to incorrect conclusions. Why do we have such low home sales? Well, that's the leading, that's what you want to dive into for a root cause analysis. You don't just look at data and then fictitiously come up and say they're predicting big trouble ahead. Well, are we in trouble today? Was 22 and 23 trouble? If 22 and 23 were not trouble, well, why are these numbers trouble ahead of us? Is it just because they're low, but they're increasing? Does that mean that interest rates will remain high and affordability will remain low? That would actually be a bullish prediction, because if interest rates stay high, it wouldn't mean that we would get a crashing real estate market. There's a lot of things that you can look at the data and completely get wrong. To me, this looks bullish, and they're saying that we've bottomed in 23, 24, and we're actually going to go higher. But they're probably predicting, I'm just guessing here, that rates are going to remain high and affordability is going to remain low. So I don't know how some of these guys come and they draw these conclusions, and I don't see any of the reasons behind it. I don't see a root cause driving to what is causing that problem. And in engineering, that's exactly what I would go for. In order to fix problems, in order to solve problems, and to fix something that will fix the root cause of it, you have to dive deep into the data and see what is causing the problems. So what is causing the existing home sales to go down? Do we not have enough homes? Are they predicting that sales will be bad because no one wants to sell their house? Well, that's not a bad thing. That's not a prediction of a real estate crash. What is causing this prediction? What are the assumptions here? Amy Nixon, another one that I want to talk about. Housing affordability is the crux of this inflation cycle and this election cycle. No, it's not. What are you talking about? That's not the crux of it. Roughly half of our country has a very low fixed rate shelter payment. The other half is drowning trying to tread water with rising payments. It says younger Americans don't want to have children in today's economy housing market study. 91% of Gen Zers say housing affordability will determine their vote in November's election, survey finds. So housing affordability is the crux of this inflation cycle. No, it's not. You know what it is? It's a larger demographic interacting with an underbuilt housing market. And that's why the housing affordability is where it's at today. How do you fix the housing affordability issue will determine the affordability of it. I mean, if you're going to build a lot more homes, if you're going to build a lot more multifamily homes or single family homes, that might fix it, but it depends on what the cost is to build new homes for single family housing. And multifamily, I mean, it obviously depends what the break-even numbers are at. If people can afford a $400,000 house, some random family, but it costs $700,000 to build a brand new home, does it fix the problem of that family who can afford a $400,000 house? It does not. And what could occur is that people are just going to get priced out of the housing market, and you're going to get a lot of people who can afford homes at lower prices, but they might not be able to afford them at higher prices. So housing affordability isn't necessarily the crux of the inflation cycle. It would be the cost of building new homes in that particular case. Then you need to dive down and say, why do homes cost as much as they do? And then you keep diving into it. Is it inflation in labor? Or is it the construction materials? Is it a combination of both of those things? And you dive deeper and deeper, trying to find out what the actual crux of the situation is. Maybe we don't have a housing affordability problem in a couple of years. And some people are saying, with the birth rates and the death rates and how this all interacts with each other, that with time, maybe it will self-correct. I don't know. Because when I look at it, it looks like we've got a larger demographic coming and we're going to be in a squeeze situation for a little while when I look at the data. But I don't think any of these people look at any sort of data the way that maybe I do, or maybe they're not looking at the right data and coming to incorrect conclusions, which I see all the time on YouTube and Twitter. At least my opinion is of it. Here's another incorrect conclusion guy. Price cuts on the U.S. housing market just surged up to the highest level in 5 years. With 22.1% of listings in May 2024 receiving a price reduction that's nearly 3 times higher than the pandemic low and rising fast, signaling a weakening housing market where prices are likely to drop in the second half of 2024. This guy has no idea what he's talking about. So what he's talking about is he's got price cuts on the U.S. housing market. Do price cuts lead to declining house prices? No, that is not necessarily the case. We had 2017, 2018, 2019, this entire time frame, we've had house prices go up the entire time. In 17, 18, 19, 20, and we've had this fluctuate down and up during that time frame. So as the highest price cut percent, we are also looking at lower and lower inventory levels down here. Yes, inventory is going up, but it's from a very low level. So you're taking a higher percent cut. You're taking a percent cut of a low level of homes that are on the market. And I'm sure as the market does fluctuate up and down and the percentages and what people think their housings are, their house is worth, I'm sure there's going to be a disconnect between what people think the house is worth and what it actually sells at. So maybe there is a disconnect of what people think their house is worth versus what they can actually get in the market. And that's really what it is. Price cuts is the difference between perception of the home seller and the actuality of the market. Then you also have to look at, well, maybe the homes that have been sold in 21, 22, 23, and 24 have been crappier homes, because if people don't want to move and they want to hold on to their house, they're probably holding on to their house because they don't want to move because of a mortgage, and maybe they like the house on top of it. And maybe the houses that are out there are crappier homes that are coming on because people are like, I just want to offload this thing. I don't know. And I don't think he knows. He's just saying, since this is going up, we're going to get declines. But he also said that we were going to get declines all the time over here. He's been a housing bear for many, many years. Why would I listen to this guy if he's always wrong? I don't know. True power, Warren Buffett says, you will continue to suffer if you have an emotional reaction to everything that is said to you. True power is sitting back and observing things with logic. True power is restraint. If words control you, that means everyone else can control you. Breathe and allow things to pass. I'm actually really good at this. I would say that this is probably one of my strongest attributes or traits as a person, is not having a super strong emotional reaction to everything. I do talk a little bit loud sometimes on topics that I really like to talk about. That doesn't mean I'm getting emotional over it. And you can hear me kind of adjust my pitch and tone and all that stuff. So things that do kind of annoy me, I do talk a little bit different, but it doesn't mean that I've got a huge emotional reaction to it. I can tell you people who do have emotional reactions to everything, I am not friends with them. I cannot stand that type of action. And I will say a lot of females that I have dated or were friends with in history have a lot of very emotional reaction moves. And I don't know what that necessarily, like why that is the case. It seems like guys don't have that emotional reaction and girls do. And maybe it comes down to how we're treated in society and how parents treat boys versus girls, and the realities of the differences that we have growing up. But I've just seen they seem to possess more of those emotional traits than a lot of the guys, at least. And remember, I come from more of a math, physics background where a lot of those guys are pretty emotionless. So that's the people I kind of hang out with, and the emotions are pretty much locked down. So I agree with that quote, though. It says everyone wants financial independence until they find out health insurance is like $2,500 plus a month for a family of four. Totally agree with that. My wife still works. She just works for the health insurance for the most part. Jeff says, here is one that I've been getting wrong. Before COVID, you could catch outperformance by consumer staples over the broad market in periods when unemployment was rising. In this cycle, the opposite is occurring. I continue to like consumer staples here, but yikes, frustration. Um, does this deal with the interest rates and inflation? That's what I'm wondering. But you can see that this went up with the consumer staples went up with unemployment rate. Now that the unemployment rate's kind of moved shifting up, we continue to see this decline. Is there a shift in the market that maybe a lot of people are not seeing? And is there something going on underneath that people maybe aren't connecting the dots here? Is it interest rates? Is it an inflationary slowdown like stagflation that we haven't seen since the 70s? I don't know. I'm just kind of figuring like what's going on here. There's something going on underneath, but I don't know the answer. I'm just telling you guys there's a disconnect. The majority of Warren Buffett's net worth has come after he turned 65. What does this tell you? This is compounding. Not a lot of money in the beginning, and you can see he got to 67 million, and that's like when things really hit. 376, 620, 1.4 billion, 2.3, 3.8, and then it compounds upward as his age goes up. The power of compounding. The 7 jobs held by millionaires. So this guy says an engineer, management, doctor, surgeon, lawyer, attorney, accountant, CPA, real estate agent, and professor, teacher. What's one thing that you notice? I would say it's probably higher earning jobs and most likely higher IQ. So I think they're all tied together. It's personality traits of savings, and then also on top of it, it's the ability to generate income. So it's the combination of personality traits, IQ, and income. That's how I would break it down. And what they did is they said the top jobs held by millionaires. So they took and restricted the wealth. So millionaires, and then they went backwards. So if you were to look at the top 7 jobs, they say, okay, all these people they all possess these characteristics. So they probably all have high IQ, a personality trait of savings, and an income that is higher than average. And that's what you're left with, is exactly that. It's, yep. Shocking stat of the day, home prices in the United States are up 47% since 2020. The median home is now selling for $421,000, which means that the median home is now selling for $135,000 more than it was in 2020. All as the median mortgage rate has roughly tripled from 2.7% to 8%. On top of that, home price growth so far this decade is on the verge of surpassing all growth seen in the 2000s. During that time period, housing prices soared 47.3%, including an 80% spike before the 2008 market crash. Buying a home is officially luxury, look at including an 80% spike before the 2008 crash. So I think this deals with the demographic interacting with the housing market and that we are short houses. And housing prices go up with interest rates. That's another misnomer that most people do not understand. House prices go down, and generally interest rates go down with house prices. And affordability goes way up. So when the housing market gets squeezed, the credit coming into the system forces rates higher at the same time that affordability gets worse because we've got a demand supply problem. Markets and mayhem, he says, trading is about probabilities, not predictions. There is no certainty in anything, and most, especially markets. One must endeavor to align the probabilities on their side, manage their risk, and execute according to their plan. Rinse, repeat, and build consistently. I agree with that, and there's strategies to it. My strategy is ratios, market conditions, and technical analysis. That is how I manage my risk. That's what my plan is. And the probabilities of my success are based in those 3 things. It increases my probability of success buying assets when they're undervalued and when the market conditions are changing into favor of the undervalued asset. And that's really how I manage my risk and that's my strategy or my plan. I'm going to be a millionaire and will never own a Toyota Corolla. I've never owned a Toyota either. I've been a Honda guy. I've owned multiple Hondas. Well, actually, I've only owned one Honda after I think about it. And I own a Chevrolet Aveo. Awesome, isn't it? I bought it new back in 2005 and I'm still rocking it. I do own a couple of other cars too that are fun cars, but that's my daily. And I really don't, it doesn't matter. I don't really care. If you're trying to keep up with the Joneses, good luck. And, you know, you're not going to find, I don't think that you're going to find more satisfaction or more luxury driving a different, more expensive car. All you're going to do is you're going to have higher insurance, you're going to have higher registration costs, it's probably going to get less gas mileage, and your part costs will probably be more expensive. And some of the luxury cars, they're a really big pain in the butt to fix. My car is absolutely stupid simple. It is so easy to fix, and a lot of the stuff I don't need to fix because it doesn't break on the car. What does it mean to be rich in the United States? So this is what he thinks, or maybe I don't know where he pulled this, but he says the U.S. average net worth by breakdown, lower class is 16,900 for the average net worth, 58,169, 300,000, and upper class is 793,000. Do these numbers surprise you? If that's the case, then everyone I know is upper class for that most part. Because, I mean, that would include a lot of the people that I know. Um, I mean, lot. They're all going to be in upper middle class or upper class, almost everyone. So I don't know if these numbers are accurate or not. That would include, my brother, my parents, friends, like a lot of people. Um, that would be upper middle class or upper class. So I don't know. I don't know if that's true. Maybe it is. Maybe it isn't. I find it hard to believe that upper class is a 793,000 average net worth. Because really what it means is where do you draw the lines and the boundaries? Why is this upper class? And who decides what upper class really is? I don't know. Maybe it is, maybe it isn't. The global easing cycle is underway. Is it too late, though? Are we really under a global easing cycle? I mean, maybe. I know we've got the ECB, Canada, maybe even US. Maybe it's all coordinated. Maybe it's for a presidential election. I don't know. But what if we draw a trend line through here, and this is just a retest that's going to come back down? Tough to say. Cutting rates when the fight against inflation is hardly over will likely prove to be a rather significant mistake, and that's kind of what I'm betting on for commodities to rip it, and it will be a mistake. And I think the housing market's going to go up because that's what the charts are positioned to do over time. I think ECB and Canada. Next is America in terms of breaking. The ECB lowers interest rates for the first time since 2019. There's that easing cycle that they're talking about up here. Now, is it going to continue? I don't know. That's what I need to watch, or I am watching. Nat gas bottom picking is fraught with dangers. Why will always have multiple ducks in a row before execution, and then with trimmed position sizing, adding as we go, with the exception of some roller coaster like turns. But yeah, I think I wouldn't use a UNG. UNG is a horrible instrument to do this. It will naturally decay to zero. But natural gas has bottomed, and I do think that's a good area. But UNG is one that I would avoid because of the rollover of the contracts, and they lose money when this stuff occurs, and there's this natural decay to zero. What are you liking less and less as you get older? I like this question in general. What am I liking less and less? Here's something I like less and less. I don't like having a ton of things to multitask. I like focusing on things more like focus is more on a couple of things instead of a bunch of crap in my life. And it seems like a lot of things are exploding that I have to remember. As you have kids, there's like 800 freaking things with their school, and if you have 3 kids in school, there's all these things going on. If they're in sports, you have to remember all of that crap too. And then there's just all this crap. So as I get older, I don't like dealing with remembering all that crap. I want it to go, partially away so I can focus more on certain things. I don't put up with companies that don't have their crap together. So I won't deal with companies that don't have their crap together. So there's a lot of companies that I just don't go to anymore. And there's a lot of things that I don't eat at a lot of fast food places. It's very, very few places that I eat that I actually enjoy. And I think when you don't have a lot of money, you kind of just buy whatever you can afford. But when you gain more money, you become more selective and you start to become more picky and your value of time goes up. So you're like, I don't want to spend time doing this crap. And you just don't, which rightfully so. If you've made the money, you can kind of not do the crap you don't want to do. So yeah, that's kind of some stuff that I do or liking less and less as I get older. That is the clear historical breakout we're looking for. So it begins for silver against the S&P 500. When the price of this ratio moves up, silver outperforms the U.S. stock market. Totally agree. And then Texas leaders want more natural gas power plants on the ERCOT power grid. A lot has to happen in the last 2 weeks to help this become a reality. And check out this, guys. It says first up is the update of the Texas Energy Fund, a $10 billion bill mostly for low interest loans for gas-fired plants. Developers filed 125 notices of intent to apply by 5/31 deadline. They're requesting about 40 billion for almost 56 gigawatts, which if built would nearly double ERCOT's gas capacity. So some of the applications, a lot of big generation of power coming from natural gas. There's more natural gas power plants coming in. It says the Texas A&M system is also offering up to its land for developers to build nat gas-fired power plants. State leaders for Texas grid urgently needs more dispatchable generation that can adjust power output at ERCOT's command. That's because Texas could see a 78% increase in power demand by 2030 as oil and gas electrifies and more data centers, crypto, people, etc. move here. So we've got a lot of potential demand for electricity generation coming for natural gas. So all these people who think that increased electricity is going to be nuclear, I think they've got it wrong. I think it's all going natural gas. I think nat gas is an incredible opportunity, absolutely incredible for investment. And just one of the reasons was that. Very bullish read for anyone interested in oil field services and rigs, and that's the growing demand to increase upstream oil and gas investment needs 22% by 2030. We've got a huge spending coming up to increase production, and it's going to have to go through energy services. Oil higher as traders shrug off a small crude build. Make no mistake, market will draw heavily in coming weeks as the adjustment factor reverses, and OPEC, the moves will get digested. KSA will not dump supply next fall unless warranted. Ignore the clickbait and focus on Saudi self-interest. We also have one here from Uselink, Nat Gas breaking out. Looks absolutely fantastic here for a big move in Nat Gas. I like it. And that's all we've got for today, guys. So give me a thumb up for the content. I don't know why. Okay, there we go. Should be coming up here hopefully shortly here. There we go. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you haven't. And we'll catch you next time. This is Finding Value.